In this episode, I'm with Stephen Capello, who recently stepped down as CEO of Hume Bank after 8 years at the helm. During his time there, he and his team made some bold and even contrarian moves, and I take this opportunity to peek behind the curtain to understand what was driving those decisions. I found this session both enjoyable and insightful, and I hope you do too. I'm John Critchley, and this is From the Helm with Polaris. Hi, Stephen. Welcome to From the Helm. It's fantastic to have you on the podcast, and really grateful for your contributions and looking forward to the conversation.
Hi, John, and thanks for having me, and very much looking forward to this conversation.
Fantastic. Now today, what we're doing is we're talking a little bit about decision making and how sometimes we have to make decisions that either on the fly a bit. How do we make those decisions in uncertainty and so on? But also, how do we structure ourselves around decision making? So there's a gap that banks often have around deciding a strategy without a good diagnostic of their situation. I think that's one of the big things we'll explore in this episode. So to start off, my question for you is, I'm sure you've seen mutual banks go through the process of building the strategy, communicating it, and then watching them as the gap opens between the plan, what they've stated they do, and what actually happens. What's your read on what's actually at the root of that gap?
Most banks don't fail because they have a lack of strategy or even a lack of vision. Most boards and executives team can probably articulate the vision and the strategy pretty clearly, pretty compelling. They will have aspects such as growth and digital transformation and expansion and all those words. But I feel that too often banks and mutual banks, perhaps in particular in the smaller ones, which most of us are in that category, are probably on a path of continuous improvement rather than asking perhaps the questions that we should be asking, and being brave enough to perhaps challenge the status quo. What do our organizations need to look like to be perhaps relevant in the next 5 to 10 years? And it's a pretty uncomfortable truth for many organizations to ask that question. Because really the challenge is that you can't really close that strategic gap just by working harder. And I think you can only close that gap or that strategic gap if three things come together. And, first there's got to be a market opportunity that's not only large enough, but actually economically worth pursuing. It's not just a niche, it's got to be a pretty meaningful place or space for, customers to be gained. Secondly, there's got to be a very genuine value proposition. It's not a value proposition that you can deliver just the same as everyone else or slightly better. You've got to be able to deliver it meaningfully better. And the third one, I think most importantly, I think is what we're going to explore today, is you've got to have the culture and the capability to execute. And without that, your strategy and your vision is really just an aspiration. So that's kind of where I'd been seeing it over the last, certainly the last 10 to 15 years that I've been in the sector.
But then going further upstream, you were talking about how there's not a shortage of vision, right? There's not a shortage of willingness to contribute to that vision. But what about the actual, what's the question or the problem that the bank needs to solve in order for it to actually resolve itself around that so that its strategy has meaning?
Well, firstly, I think there's an assumption, and it's an assumption that many of us know where opportunity is. It's an assumption that we know what our customers want and why customers choose us. Are those assumptions right up front being challenged as much as they should? Because in many ways, the question that we all ask ourselves in banking is, if we were to disappear tomorrow, how quickly and how easily would our customers be able to, substitute us in or replace us in for another organization? And it's pretty confronting. But the reality is that most banks probably see or may see a unique value proposition, but it's actually, you know, table stakes. It's just your ticket to play. It's just your ticket to, um, come to the table and play in the space of banking. But the thing that makes you special, um, in many ways, is probably just required. Um, and we may think that our point of differentiation, for example, is personalized service or relationship banking, but every bank and every lender is saying the same thing. That's not a differentiation. It's just an entry point. Um, and the trap is, in many ways, leaders can spend an enormous amount of time, money, and strategy, articulating, defending something that they genuinely believe sets them apart. But the market has probably long moved on um, since that point in time, and so you're kind of taking for granted what was perhaps a point of differentiation, but the market has moved on. So I actually think the problem isn't necessarily poor execution in the first instance. I actually think that comes comes to the surface quite strongly down the track, but that the strategy itself is perhaps built on a false premise about what actually differentiates yourself in the first instance. So, is the sector and many of us actually answering the wrong question in the first place to derive their strategy? Because you may be making the wrong decisions right up front, or misdiagnosing what your real strategic gap is in the first instance. So, and then obviously, execution becomes a problem because you've misdiagnosed problem is up front. Yeah.
And actually, if you look at what goes on in the sector, I'll use a data point that's often referred to quite a lot, and that's about customer satisfaction, right? But then you've got a retention issue in the sector. We all know that too. So if they are so satisfied, why is retention such a problem?
And this is, again, potentially one of the challenges that organizations face when leading into that. So you've gained the customer, but you haven't managed to retain them. Perhaps that's a servicing in real operational sense of what I've certainly observed in my experience, is that organizations, once they've actually been comfortable setting their strategy, they often only focus on one part of that value chain and ignoring other parts. For example, they identify, growth is the key strategic objective, and they identify growth opportunity, and they invest heavily in customer origination and customer acquisition and products and channels and all that capability. Growth then follows. Everyone's celebrating that we've got balance sheet growth, but then the operational maturity across the end-to-end value chain actually fails to keep pace. And so what happens is, processes become strained. The ways of working haven't been kept up. Service starts to deteriorate. Customer complaints increase. Customer retention starts to drop, and growth slow. So the irony in that case is, it's not that the strategy was actually incorrect. It's that the organization just wasn't ready on an end-to-end basis to actually succeed as much as they have in the past. So, and I've seen that repeated quite consistently across the industry, where the growth that you're able to achieve up front through early strategic success, it actually hides or exposes some weaknesses that were hidden when the organization was at a much smaller scale. And perhaps that, John, is what leads to maybe a more provocative point where, do banks, generally overestimate the quality of their strategy, but underestimate the importance of that organizational capability that you refer to, and the need to actually invest in. So the question for me isn't whether you've got a strategy. I think all banks have a strategy. It doesn't have to even be your own if you're clever enough. But the question, I suppose, is, can that organization realistically deliver on the strategy you've written? And are you prepared to make the investments in technology, in leadership, perhaps leadership changes, cultural changes, and so forth, necessary to become that organization that you have a vision to be. Yeah.
I think what's interesting, you made a point, and I might just be a little bit controversial in pushing back on the strategy was right. Yeah, it was the context afterwards, after the strategy in which it was implemented, was not right. I would say that in a way, you could almost argue that the strategy wasn't right because the context wasn't diagnosed. And so therefore, if you diagnosed your context, you might have a different strategy. So was the strategy right or wrong? I would suggest possibly it was the wrong strategy because the diagnosis hadn't been done up front to actually give it context, perhaps.
I mean, that's a common trap that a lot of leaders do fall into, is that misdiagnosis up front. But on the assumption that you've truly done, and truly stepped back and truly done your market research, truly understood whether there is a gap in the market, really analysed, what needs to be true for that opportunity to be tapped into, and for growth to be achieved. A lot of the gap then becomes an execution gap on the assumption that you do get your strategy right. And where we find, or certainly where I've observed that execution gap surfacing is when it's also, focus on one end of the organization's or the bank's operating model or operating value chain. And so therefore there's a maturity gap on the bank's internal capabilities, which perhaps then comes into the fact, the point you raised, we're able to gain new customers. Yes, fantastic, because you've invested in customer acquisition, but you're not retaining them because you haven't invested in customer retention. Yeah.
I think you're right there. Now, you've been in the seat, of as chief executive before, and where you have, I've watched the work that you've done there, and you've made some very, very bold choices. I mean, you went out and got credit rating, where that's an unusual thing to do in the mutual banking sector. You also went the opposite direction on branches and started actually opening branches, not closing them down. What was your thought process around that, and how did that become coherent as a strategy?
You know, for us, the starting point was, what type of organization do we want to be? And for some organizations that could be, what's your purpose? And again, to be a purpose-led organization. So we're able to start with understanding where we want to be a purpose-led organization. It wasn't actually recreating or reinventing what our purpose is. It was actually tapping into what was for the past 65, 70 years, but surfacing it in a much more meaningful way. Really, the importance of that point of purpose is that it only creates value for the organization if it's if it changes behavior. Does it influence decision points? Does it influence the culture of the organization, priorities, resource allocation? Otherwise, it's just a marketing campaign. So the operating model was the next key question. That again is a grounding anchor point. We chose a specific operating model that was designed to tap into what our competitive advantage is, or our advantage is, but it also was designed to recognize where our strengths and weaknesses were. And so when we're making decisions, we're anchored by our purpose, we're anchored by our vision, for example, and we're also anchored by our operating model. So the bank was in a particularly fortunate position where our operating model was, shaped by the fact that we were tapping into both home and away markets. And that was one of those real key strategic choices we made up front, was that, for many smaller organizations, having a market that is large enough to actually build growth meant, for example, the likes of Hume Bank, we decided to operate in both home and away markets. But we were realistic in the sense that there are better players in our sector to distribute our products in the away market. So we were a product manufacturer in that sense. But in our home markets, we design an operating model around your typical strategic advisor, your trusted advisor in that sense. So we have a dual operating model, and a lot of the decisions that we made were anchored by being a purpose-led organization, having an operating model that made sure that value was created for all stakeholders, but being true to the sense that we're a manufacturer of banking products, but also a trusted advisor to many in the home market.
I mean, you talked about true purpose-led organizations. Everyone talks about purpose-led in the sector, but where it becomes relevant and useful on a day-to-day basis, and you can see the product of that usefulness in decision making, you can unpack it and then discover the DNA of the organization in the actions of them, of what they do and how they carry out the strategy.
Absolutely can. And I'll give a case example. I think you mentioned it up front was, we made a very unconventional decision when we decided to open up a branch I think it was maybe 2024, 2025, in a small regional town when at the time, most of all the majors were closing branches, and most of the broader industry was probably going in the other direction. And on the surface, it looks like a banking decision, but in many ways, it was more our purpose and competitive advantage. And one of the probably the dangers of just following a strategy blindly and following industry trends is that just because something isn't right for the industry doesn't mean it's not right for your bank or the sector. And it can actually be exactly where your competitive advantage lies. And if you can actually execute on that decision better than your competitors, then that's where your advantage lies. So the question we asked wasn't, why or what is everyone else doing? The question is, could we do it, and could we do it better than everyone else? So we saw a value or an opportunity to create value and shared value for customers, community, and the bank. We gained the opportunity in many ways to develop relations with the community and be the provider of banking services there. Importantly, we didn't do it as a charity, and I think it had an economic reality to it. We partnered with the local community, so it was a true partnership model. And we believe the purpose, approach, and commercial outcomes would reinforce each other. And so within 12 months, we would have virtually doubled the balance sheet size of that zone or that region of the bank by adopting that approach. So, when we look back, the lessons that we learned was that we didn't take a one-dimensional approach to do you open a branch or not, and is it going to make money? But if your purpose is real and if your operating models actually work, it actually creates opportunities that others can't see or they just don't want to see. So that was the lessons learned for us.
And it actually puts the purpose and your strategic rationale under the microscope on a daily basis, because then you consciously time back your decisions to the strategic framework. If you were to make decisions on a fairly operational level, that is, we should open a branch here or not open or close a branch there because it's either costing us too much or we've got a footprint that's better over there. That's a reactive approach. But what you're talking about is actually building position in market that actually is distinctive about yourself and underpins your strategy, but then at the same time, it has to be refined in the crucible of reality.
Decisions don't generate instant value. So value creation from a banking perspective, can take many forms, but and really value creation should be circular in nature. If you're creating value for one of your key stakeholders, whether it be the community or customers and bank, they don't all create value simultaneously. So it's circular in nature. And so in many ways, it's a test of your strategy and a test of the clarity of your strategy, that you're comfortable making decisions that perhaps create value for one stakeholder, whether it be community, on the premise that if if you stay true to that approach, then it will return itself via value creation for the organization as well, because opportunities are then explored. Another example, John, would be we took a pretty clear stand on supporting family and domestic violence, and quite a prominent stand against that, and that reflected our broader strategy as well, and our strategy about supporting customers that are impacted in that space. But it wasn't a compliance initiative, it wasn't a marketing initiative, but it was a strategic decision about what type of organization we want to be. So we, once purpose led, but we genuinely believed that there were moments in our journey that we needed to act upon. That one, we wanted to be a socially responsible organization or bank, and I think the broader sector needs to be socially responsible. But also, and our community expected us to take a stand. And contrary to perhaps the initial lens, family and domestic violence is an issue a little bit close to banks than what we all realize, because our products can be used as a vehicle. But the level of trust that then comes from taking those strategic decisions to be an active participant in community issues, the level of trust that then is developed. If you measure trust, and if you've got a trust barometer, and if you recognize that community and customer trust is one of the key reasons or key decision points, then strategically it's a very sensible move. And so, we chose not to step away from leaning into key community issues. We actually made a very conscious decision to lean in even harder. So that's a real test of whether you're prepared to, as an organization, to, be true to your purpose, be true to your values, because there's a risk either way. So that's another example where, grounded by the work we did up front on purpose and the work we did up front on vision and strategy and the operating models that come with it.
And you had surfaced issues that were really important to them, and you identified with them, and you actually aligned with it as a differentiator that was distinctive but also relevant to your members.
Our connectivity with community is a real example of, how do you know your strategy is making the changes you want? How do you know you're succeeding? And how do you know it's working? One of the questions we often asked ourselves is, is our strategy working in changing the way the organization is evolving? Is it, are we evolving into the organization that we want to be? And this doesn't just take the financial perspective; it takes, and not just a rate, but it creates. It's whether the bank is actually becoming what we set out to create. And so, for us, the starting point isn't measurement, but it's the starting point is the vision. So, for example, and we would reset not the strategic vision, but the annual vision of the organization every year. Do we want to be more connected to our community? Do we want to be more impactful? Do we want to be more customer centric? Do we want to be simpler, or do we want to be more digital, for example? And it's important to have that broader lens, but that's also where it gets slightly challenging, because traditional metrics are pretty easy to measure. Your balance sheet growth, your profitability, your cost income ratio, they're pretty important to measure, but they only measure part of the story. They don't measure the whole story. They tell you how your bank's performing, but they don't necessarily tell you how your bank's evolving. And that's the true the true measure of whether your strategy is working is whether you're actually evolving. And we spent a lot of time making sure we had a clear understanding of what we wanted to evolve into, and then develop the measurements to actually give us a sense. Some very difficult than others, but are customers finding it easier to do with us? Are we better connected to our community? Are we creating the digital experiences? Are we having the social impact? Are we creating value for community customers? So, those measures are often a lot harder and a lot more nuanced. Some are unique to the organizations. And I think that's where leadership can actually be a lot more challenging for small organizations, because you're faced with trade-offs between traditional measures and non-traditional measures. But I think that's where the strength of your strategy, the strength of your leadership team, and the strength of your focus starts to surface the most. Yeah.
A key factor in the strength of your strategy is its ability to be resilient to change in the context in which you have actually established your strategy. So your strategy is pretty much a hypothesis of your future. Yeah. But that hypothesis comes with assumptions, and the strength of the strategy is its resilience to those assumptions and your ability to respond if the assumptions become changed or altered, or at least the impacts those assumptions are coming from external influences, or indeed internal influences that mean that your strategy has to evolve, as you were saying. Can you just go through some of your experiences around where your assumptions were really challenged, or in fact invalidated by reality, as you went through the process of executing the strategy, and what did it have as an effect on the strategy itself? You don't want to throw the entire strategy out, but to your point on the word of evolve, it would probably have to evolve in some way. Can you just pick out from your experience where that challenge emerged and what you did in response to that?
We've certainly always adopted, and I've always adopted a strategy always on. Now, in principle, that means that you should be open to revisiting the assumptions and the market to make sure, and opportunities as they come forth. That may also mean that having a strategy always on approach isn't necessarily changing your strategy, but it's also being adaptable on your execution path. So there's an example is, merger opportunities aren't necessarily built in your strategy, but when they come along, you need to assess them on their merit and reprioritize and so forth. So strategic execution can also be always on because the market changes. In our case, there were some assumptions around the customer value propositions in terms of the broadness of it and the complete nature of access points, for example, that were valid at the time, but not so much in hindsight, but at the point in which we were looking at executing on that, we were able to actually step back and reassess things. So just because we made an assumption in the strategy, 2 years later, when it came time to actually assessing whether that was still something that our customer base valued, we were able to perhaps retest the assumptions and then present back to our board in this case that, well, the assumptions we had 2 years ago, they actually don't stand now. There's been a change in customer preferences. There's been perhaps new players in the market. Perhaps the barriers to entry are a lot higher than we thought. Perhaps the investments required just far outweigh the economic benefit that we're able to derive from it, or the value that our customers receive is going to be that narrow. So we certainly made those decisions not to progress on certain aspects of our strategy, minor aspects rather than the larger ones. And we also took the opportunity where new things came and new opportunities were presented to us. We were able to create space because we could actually understand the trade-offs between something that we had identified in our strategy versus a new thing that has been identified, which one is going to create the most value, and on a broad basis as well. So value for customers, community, and our people, for example, but also banks. So those trade-offs are real, but we certainly had a way in which we were able to assess them based on the traditional factors you would, speed and which you could execute on, cost of execution, the speed in which you could generate value as well.
I think there's also a tolerance for accepting that actually the assumptions are just that. They're assumptions. They are well informed with what you knew at the time when you formulated the strategy or plan. The plan precedes the activity. And by definition, you can't know what's going to happen when you start acting on that plan. There are too many things in the universe that changes, as we know. I think the question then comes to, how do you prepare board relations? How do you prepare member relations? How do you prepare staff readiness to cope with the stresses that come with that? And how do you mitigate the impact of those stresses as assumptions change and the strategy feels like as if it's changing, but it's not really. And decisions still have this codification and like a DNA that you can always point back to. How do you want to explore that one just for a few minutes?
I mean, it is one of the key challenges, and strategic change is a key challenge from most smaller organizations in our sector. But the reality of the level of change that's required in our sector just to ensure relevancy and just to ensure that in 5 to 10 years' time, we're still a thriving sector. But at the same time, in parallel, running a regulated bank that has customer demands and delivering value and so forth. So you've got this trade-off and these constraints that are in place. It's not impossible because just our sector has got a wonderful track record of reinventing itself and transforming, but it's not an easy pathway because of that. Those dual tracks, one your change track and one your business as usual, and running a very high demand bank in a very competitive banking sector. So I think one of the first lessons that any organizations can have is your strategy needs to be fit for your organization. And sometimes the gap is not a strategy to execution gap. It's actually a strategy to an organizational reality gap. And the organizational reality for any organization, whether it's a bank or whether it's a manufacturer or whether it's a health organization, if you're not true to the reality of your organization when setting your strategy, your success probability of execution is going to be significantly compromised.
And that just brings it down to, you can't have a templated strategy. You need to have context, and then judgment and knowledge within the organization to be and or across the sector to be able to come up with an effective strategy. And strategy, I like it. Strategy doesn't go away. It's always on. And I agree with that. If you think that strategy is just going to happen every 3 years, yes, perhaps the core pillars of it may be relevant for 3 years, but or maybe your objectives may remain valid over the 3 years, but the assumptions behind that are going to get tested, and you can't just assume that they're going to stay valid for the 3 years. In fact, it would be very unlikely, and you'd be incredibly unique if that was the case.
Yes. And in many of the cases that we've seen recently, your change, your capacity for change is increasingly being consumed by someone else's agenda. So whether it be a regulatory agenda or the market agenda. So your ability to transform and change to give yourself a competitive advantage is constantly being squeezed. And so that again is a leadership challenge that every organization in the mutual banking sector will be faced with on a daily basis. It doesn't surface itself at the annual strategic planning cycle. It actually surfaces itself on a daily basis where your own agenda is being squeezed out by someone else's, which is a very difficult position to be in, but one where you've got to navigate if you're going to have a sustainable bank in many years to come.
I posted something about this about a week or so ago around degrees of freedom, right? The degrees of freedom within the mutual banking sector, and indeed many of the member-based organizations, very narrow, particularly when you're regulated. You don't have many degrees of freedom, and so the choices that you have are limited. So being able to identify which choices you've got and then divert the right amount or allocate the right amount of resources to be able to execute against those key choices, they're going to give you strategic advantage. And that comes back to your purpose, right? We don't have in this sector what is known as an embarrassment of options, right? You've got a very narrow set, so you've got to identify them, and then the other one is be able to execute on them very effectively.
Absolutely, John. And in many ways, the old basic strategic planning approach, where do you want to play and how do you want to win? In many organizations, where to play is built on, a legacy, a bond that has legacy to it, which is could be your strategic play, but because it's the only advantage you have over someone else. But and then how you're going to win. So once you've identified that segment, how you're going to win, what's your winning value proposition. But are organizations, brave enough to be asking the questions, are there particular segments or markets that I'm just not going to play in? Are there particular products and services that I'm just not going to provide? Because I can't be everything to everyone, because if I'm being squeezed out, I forget the terminology used, it's a very narrow path. If I've got a finite limit of resources, can I afford to be everything to everyone? Because in many ways, the mutual banking sector have come from that path where you never turned anyone away. You were then you slowly developed your products or service suite that you provide a full service and a full product suite, but that brings complexity, and it's not really also fit for scale and efficiency. And so those organizations that are going to succeed going forward are perhaps not the ones that just have the best strategy. They're the ones that are brave enough to make those real clear and well diagnosed and well thought after, well challenged trade-offs, and those real key decisions that will make sure that they're still in their communities in 5, 10, 15 years time, creating the value that they do so well at.
There's going to be also a transition as intergenerational expectations of what is expected from banking will change. The tools out there will shape that expectation. Digitization was a thing, in the early 2000s all the way through to about the 2010s, where it was a differentiator at first and then gradually became normed. How does AI fit into that scheme? It's just these things are going to change the landscape of what is normal, and strategy of organizations is going to have to shift and manage that. You can no longer call out things like AI chatbots as being differentiating in about 5 years' time, for example. They will just be standard, and if you don't have them, you haven't got the table stakes to play.
100%. Yeah. And then that also comes to one of the other challenges that we have as a sector is speed to market. Because the old advantage of when you're nimble, small and nimble, you've got an advantage of speed to market. But the larger, so you're faced with these, trade-offs. The larger you get, the benefit of size comes with it: great investment power, ability to attract talent, and so forth, access new markets. But it also, in many ways, can slow your organization down. So what used to be an advantage of speed to market is now perhaps compromised to a certain extent. So by the time you're fully embedded change, um, the rest of the industry has moved on. So, yeah, how can your organization, the industry, actually get ahead of the game? Because your 12-month transformation cycle, to put in a new platform, just doesn't actually work, in today's environment, because organizations can deploy at a much faster rate. So it's it's again, always making sure that you're looking forward beyond the first horizon, because your first horizon is many ways perhaps your house cleaning horizon, where you're just improving your organization, keeping up with the latest things. Whereas, are you looking forward, beyond, dare I say, perhaps even beyond your own executive tenure, onto horizon 2 and 3, to make sure the organization or your bank is actually set up for that future period where perhaps you're not around anymore. So again, are we making as a sector those future proofing decisions, for those periods beyond the horizon 1? I think that's an important thing that banks lean into as well.
That's great. And I think what's interesting in that is that you've got these three horizons, and we all know where they came from, and they're a very great reference point around the evolution of organizations, because they tell the story in three different compartments, but the window for those three horizons moves gradually over time. So it's not like you're moving from stage 1 to stage 2 to stage 3. All three are operating in tandem with each other. They're just doing different purposes on those horizons. Now, those are great frameworks, right? So these are frameworks that work well, are well and tried and tested. But as we already talked about earlier, assumptions are the key thing, right? Knowing what your assumptions are, and your assumptions then tie back to how well you've diagnosed your context. And that's basically at the core of it, is being able to identify very effectively what your diagnosis is of your current situation. It gives reason and foundation for your strategy. Now, you mentioned right at the beginning, actually, almost stole the thunder for this piece, is basically, talked about measures. So I think maybe just if we can just turn to that, and we'll just ask the simple question: how do you think about measuring success?
Early on, about it's it's not starting with the measurement, but it's starting with you know the vision of what type of organization you want to be, and if you're able to make sure that that's clear. And I would say it needs to be clear on an annual basis, as well as a longer term time frame. Then you're able to make sure that you're measuring, um, in the best way. Are you actually evolving into that organization? Or if you're looking to compete against every other bank, then there is an abundance of measures available for you, and you'll do a wonderful job in terms of benchmarking yourself against them. But if you truly want to differentiate yourself as an organization, then you need to be selecting different measures. And so for the banks I've led, it is starting off with what is that vision, and again on an annual basis, and then on a longer term basis, and bringing it back to an immediate term, because you've got the greatest chance of also taking your people along from the journey, making sure that they're aware of what's in front of them, the expectations, giving them that aspiration, incentive to actually achieve something shorter term, is always something to make sure you don't lose sight of. But having a way in which you can measure the evolution of your organization, to be the bank, in this case, the bank you want to be, I think is the way I've certainly had most success in my time. And again, I come back to those things. Are you making it easy for your customers to join? Are you better connected with your community? Are you creating impact and social impact? Are you simplifying yourself? Are you actually creating a simpler way of doing business? If you combine them with your traditional finance metrics of growth and cost income ratios and profitability and capital and so forth, as well as, dare I say, risk measures, that is probably the pathway I've had most success in presenting a complete picture of the evolution of the organization towards that strategic vision.
that's really good. Thank you.
Mm,
Just before we leave, I want one thing that just sparked in my mind when you were just talking about that
mm.
was that the difference between a customer-owned bank and a investor-owned bank is the fact that you've got customers and we've got members. Okay, what would be that distinctive measure around member? Because we talk about member value in the sector, right? And yet we operate as if we're working on customer metrics, typically, right? Just off the top, or maybe you've already deployed this. What would be the one measure that creates distinctiveness between the way a mutual bank measures itself versus an investor-owned bank that's quite distinctive, that focuses on that member value? How would you do that?
I mean, there is an argument that um, mutual banks should, shift away from thinking of their customers as members, and there is an argument. We're not a gym, and so therefore, you know, recognizing our customers as a true customer. I have heard an argument that that's a more more of the lens that we should be viewing our organizations. Now, the challenge that most mutual banks will have is that what differentiates themselves from a listed organization is the concept of members and mutuality that comes with it. Mutuality, takes the shape of in the true sense, mutuality takes the shape of there's value that I'm creating for you. We both mutually benefit from the relationship, and the way that in the simplest terms, the way that surfaces itself is there's value created for the bank and there's value created for the customer. Some banks, like Hume Bank, extended that to community as well. The simplest measure is not so simple because you're very easily able to measure the value that's created from the bank because it's on your balance sheet. It's the off-balance sheet value that's created for the customer that is the missing part of it. And so there have been various methods. We've used methods to create a measure to measure that the benefit in which the customers are mutually sharing in. And typically the way we see it is that it should be in balance with the actual value the bank is creating. So, we had a rule of thumb, or I've certainly had a rule of thumb in the past, that if, the organization, or if the bank is generating, X million in profit per annum, then the customer base should be equally generating X million of the same value through better interest rates and lower fees. Those were the two simplest ones. And if they were out of whack, then you should be in a pretty good position to understand, well, why? Why is one? If this is a mutual relationship, why is one side generating greater value than the other? So it's not a single measurement, but it actually can be quite a simple measurement to start with. And we certainly didn't make it complex that it took us months to generate, but a back of the envelope calculation to actually put yourself in a bit of a comfortable position to be able to explain that and be comfortable with it. I think that's a good starting point.
And it's not about the science of the numbers. To your point, it's actually putting it in place as an activity, a conscious activity of tracking something that is distinctive, that you can measure to an extent. It doesn't have to be, precise. It doesn't have to, go on some trend bar that you can, measure to within a tenth of itself. It has to be something that the real value comes from the exercise of actually thinking about it and people knowing that this is part of your decision-making process.
Correct. And to that point, John, once we've started with that exercise and this was a high level exercise and actually, and create a bit of fun to it because, most organizations, dare I say, probably don't look at that angle of it. But once you've got an example of it, how accurate it is, it actually it doesn't force, but it provides the opportunity for your organizations to back, okay, well, this is actually, I've never looked at the way you operate in this lens before. but the true value of it is if it finds its way into decisions. And one of the real pleasing aspects of that process is it found its way into our decision making process and pricing decisions, where we were able to make a more balanced decision outcomes, because we had been exposed and because we had started to change the way we made decisions. We had a shared value operating model, meaning that our point of differentiation was the fact that we wanted to create value across all of our stakeholders. And what better way to do that than actually make that decision process in our decision-making bodies, or implement that process into our decision-making bodies.
That's really great, and it's a fantastic
Mm.
insight to end on. Stephen, thank you very much for your contributions. I'm pretty sure people are going to be watching this a couple of times over, and I can imagine there'll be a few segments in this conversation I'll be going over a few times on repeat. So thank you very much for your time and contribution, and hopefully I will see you again on From the Helm.